Today we're covering the last week as per usual. We've got a red-hot US GDP report, escalating trade drama between the EU and China, and a blockbuster deal in vaccines from Sanofi. If you're into stocks, global trade or pharma plays, stick around. This could impact your portfolio. Let's jump in. First story. The US economy just posted its fastest growth in 2 years. According to the Commerce Department data released on December 23rd, third quarter GDP expanded at an annualized rate of 4.3%. That's up from 3.8% in Q2 and way above the expected 3.3%. What drove this? Strong consumer spending jumped to 3.5%, the quickest since late 2024, fueled by recreational goods, vehicles, healthcare, and travel. Exports rebounded big time, shrinking the trade deficit and adding 1.59 points to growth. Businesses kept pouring money into equipment, especially AI tech, and government defense spending chipped in too. Only inventories and housing dragged a bit. But here's the twist. It's a K-shaped recovery. High-income folks and big corps are thriving, while middle and lower-income households grapple with rising costs and labor shortages. Income side growth was only 2.4%, showing imbalances. This matters because it questions how sustainable and inclusive this boom is heading into 2026. Financially, this boosts equities, especially tech and global trade players. Corporate profits surged $166 billion annualized, huge jump from $6.8 billion last quarter. Big firms are investing strong, with non-defense capital goods orders up 0.5% in October. But small businesses, they're squeezed by costs, tariffs, and labor issues, widening the big versus small gap. Consumers are the engine, but warning signs are flashing. Slower retail sales, dropping vehicle buys, weaker confidence. Real disposable income stalled, savings rate dipped to 2022 lows. Inflation's heating up too. The PCE index hit 2.8%, above the Fed's 2% target. This could erode spending power and push reliance on credit. For the Fed, it's tricky. They cut rates to 3.75% this month, but might pause cuts with hot growth and inflation. The recent government shutdown could shave 1-2 points of Q4 GDP, adding uncertainty. Globally, US strength helps exporters, but tariffs stir volatility. Looking forward, resilience into 2026 from core investment and productivity, but uneven growth and inflation could slow things. Focus on strong fundamentals in your picks. Avoid rate-sensitive sectors. Next, trade tensions are boiling over. On December 22nd, China slapped provisional tariffs of 22% to 43% on EU dairy imports like milk, cream, and cheeses. Think Roquefort and Camembert. Most hit around 30%, effective immediately. China claims EU subsidies hurt their producers, but the EU calls it baseless and has a WTO complaint brewing. This is retaliation for EU's October 2024 tariffs on Chinese EVs. It spread from EVs to brandy, pork, and now dairy. The probes ongoing, with a final ruling by February 21st. Tariffs could change, basically. Why care? It's politicizing agriculture, escalating a broader dispute. Financial hit is that EU exporters lose competitiveness in China's $589 million dairy market. Cheese gets hammered, with New Zealand poised to gain share. EU consumers won't feel it much, but oversupply could pressure home markets and farm incomes. Broader economy adds a risk to fragile EU growth. It's a small trade volume, but big symbolically. Trade as geopolitical weapon. China benefits domestically amid oversupply and weak demand from low birth rates. Talks on EV tariffs resumed, but issues linger. EU open to price commitments over tariffs. There is room for tweaks like the recent pork duty cut, but expect more confrontations. For investors, it's about unpredictable trade flows. Diversify away from vulnerable sectors. Finally, big pharma news. On December 24th, Sanofi announced a $2.2 billion acquisition of US biotech Dynavax technology. This grabs their adult Hep B vaccine, HEPLISAV-B, and an experimental shingles shot, bolstering Sanofi's adult immunization push. Why now? US policy shifts are rattling childhood vaccines, so adult focus diversifies risk. Sanofi pays $15.50 per share, a 39% premium, and closes Q1 2026 no hit to 2025 outlook. Sanofi's hunting growth before Dupixent's 2031 patent cliff. Recent buys like Visebio and Blueprint show the strategy. Heplisav B did $90 million in Q3 sales, peaking at $610 million. The shingles candidate matches GSK's Shingrix, with better safety potential. But flu market pressure, declining rates, and FDA rejection of tolebrutinib hurt sentiment. Dynavax shares soared 39%, Sanofi dipped 0.7%. Investors like the logic, but watch execution. Success hinges on integration and trials. It's strategic, not instant. Regulatory wins and market dynamics key for performance. And that's your market wrap for the week. US growth is strong but uneven, trade wars are heating up, and Sanofi is betting big on vaccines. What do you think? Bullish on US stocks or wary of inflation? Drop a comment below, like if this helped, and subscribe for weekly updates. And of course, hit the bell for notifications. And we'll see you next time.